Hey again, guys. Mike here. Today I'm going to talk about a little bit about my portfolio and some of the companies I have in there. I'll do a quick synopsis on a few companies. I'm going to do a video on each one afterwards. So anybody who's interested in a particular company can have a bit more of an explanation. I guess just to open, I'll say why I do these videos. Primarily, I do them for myself. So that I can review my thinking later on and see where I've made mistakes and where I can become a better investor and some of the thinking that I got right. Also I do these for, there's a few people who ask me. I know some people who ask me for stock ideas. So I just, I'd rather just do a video like this so people can take a quick look if they want. And also, if anybody else in the YouTube universe gets any value from this, then that's a bonus. Yeah, just hit the like button if you actually get any value from this, just so I know what information people are resonating with. Okay, just a quick overview of my style. My style is extremely contrarian, I would say. I'm a natural arguer, and so I like to do the opposite of what the crowd's doing. So that's the investment style that suits me best is to basically look in the scrap heap for companies that have been beaten down and try and find ones that I think are beaten down for reasons that are temporary, let's say, or maybe unreasonably or maybe there's unreasonable negativity. The reason I do that is because I'm cheap. I don't like paying a high price for stocks. I like paying low prices just because I think that offers me a margin of safety. Because even if I'm wrong about my theory on why the problem will go away, the stock is cheap enough that it probably doesn't have very much downside left, even if things stay bad. I do have one quick question I asked myself after reviewing companies and researching them. I asked myself, is this company a no-brainer? Is this a no-brainer investment? And usually I know by my instant reaction whether it's a really obvious no-brainer to me. Because if I don't answer right away, yep, this is a no-brainer, then I know that I either have to keep doing more research, or maybe the company is not for me, or in some cases, I just need to wait for a lower price. That price doesn't always come, but I have a list of companies that I like, but they just aren't cheap enough for me. Like, for instance, let's say PayPal. I really like their business model. I really like the company. I really like their cash flows, but it's just too expensive now. But if it falls to a certain level, it'll get into my no-brainer territory. So I'll just do a quick overview of a few of the stocks today. My biggest position is in Alibaba, and I'll put a link below if you're interested in Alibaba, because there's a guy on a channel called More Money that does really good in-depth analysis of Alibaba. He talks. He's got dozens of videos on them, and they're quite entertaining too. So I'm going to recommend that if anybody's interested in Alibaba, they look at his stuff. The quick overview of why I like Alibaba is because I think this is a no-brainer. Of course, they are trading at 12 times last 12 months earnings, and they're trading at 10 times the prior year's earnings. So recently they started investing more heavily into merchants, which I believe is a long-term benefit. They're actually increasing their moat by doing this, but it's temporarily pulled earnings down a bit. So they're trading at 12 times earnings. That's not that cheap, but when you look at the growth rate, you get a growth rate of over 20%. They're trending at, I think, mid-20s for this year, and they've been over 30% in the past. You get a PEG ratio of about 0.6, which is, I believe, extremely cheap. So PEG is PE over growth. So that means that the PE is basically half the growth rate, or 0.6 times the growth rate. Usually anything under one peg is a pretty good deal if you have a good company, and this is a great company. They have a huge moat. They have massive infrastructure. They they have access to massive infrastructure. They're trending at 2 billion customers in the future, which is unbelievably huge. So basically, they're a bigger company than Amazon, and they're trading far, far cheaper than Amazon. And actually, they're more profitable than Amazon as well. So if you want to compare them to Amazon, then there's that. But the main reason I would buy this company, or have bought it, is that they have 7 business divisions. They have 7 units, and currently only one of them is making money. That's their China commerce unit. And the other 6 are in their growth and investment stages. So basically what you're paying for here is you're paying for the China commerce, and you're getting all 6 other units for free. You get the cloud, you get, which is potentially their biggest and best unit in the future if you give them 10 years. The CEO said this is going to be the biggest part of the company. So, and that's where Amazon makes all their money. So you're essentially getting this for free. You get the cloud for free, you get their international commerce for free, and plus a bunch of other great stuff. Their entertainment unit and all that kind of stuff. One of the other things I like is I like Jack Ma. I think Jack Ma is a very smart business builder. He has a mentality that says customers first, employees second, and shareholders third. And shareholders don't like that because they think that that he doesn't care about them. But he actually, I believe he understands that if you put your customers and your employees and make them really high priority, make the experience for them really good, the earnings follow. Like, and he's proven that this works with his China commerce thing, China commerce arm. He spent a lot of time investing in it, and now it's a monster of a business with a huge moat around it. There's a lot of other reasons to like Alibaba. One of the main ones, I think, is the macro tailwinds. The middle class in China is growing extremely rapidly. There's a lot of people moving into the middle class. And remember, they have over 1 billion people there. So the middle class in China is, China is, 3 or 4 times the size of North America. And so just based on sheer volume alone, there's a huge amount of potential customers in the pipeline in the future. And on top of that, the middle class, their earning power is going up really fast. So you have a double whammy on the middle class in China. Plus you have a lot of people in Asia generally moving into the middle class. And these are people who are going to use Alibaba. So that's the quick overview on Alibaba. I'll do a bigger video. There's a lot more stuff to talk about with them because they're such a huge business, but I think it's an unbelievably cheap opportunity. I had it on my watch list. I was talking about PayPal before, and I thought, Alibaba, I had Alibaba, and I had a buy price, and I thought, well, this is never going to get into my buy zone because it's $250, $300 a share. And it's such a great business. It'll just keep going up. But I'm just going to keep it on my watch list. And here it is. It's selling, I don't know, $113 today, which is absurd. So that's on Alibaba. Another company I own is called Shinoken or Shiniken. It's a Japanese real estate development company, and they're also a property manager. And the quick overview on them is, I got turned on to this one by Manish Pabrai, who owns it, and he talks about spawners when he talks about businesses he loves, and I believe that this is one of those spawners. They continually build new arms to the business, and they expand into new areas, and they do it all well. They keep adding new profitable arms to this business, which is an unbelievably good trait for management. So I invest with them. I get this management that's able to build the core business and also add new businesses on the side. So they've recently gone into Indonesia. They've gone into early life and later life care. They, like I said, they build. What they generally do is they build properties and then they sell them to people who use those properties as investment properties. But they also and then they manage the property for them. So basically, if you're an investor in one of their properties, it's just turnkey. You just sign in the line, they do everything for you, and you get the income from it. And this is really really popular with sort of people who are trying to build for retirement in Japan. So that being said, why is it a no-brainer? Well, it's trading at 6 times last year's earnings, so the PE of 6. And why is it trading at PE 6? Well, as usual, there's a problem. The problem was that during COVID, they had to stop development, stop building properties because everything got shut down. And so they had about a year where they weren't building new properties. But at the same time, they were still making money. And because they have all this residual income, this recurring income from their property management arm, where they still have all the contracts. And so the earnings have been basically flat over last year. And what's happening now is they're coming back online with their construction business, which will fuel growth in every area, basically almost every area. And they said, okay, we're going to have about 250% growth in Q4 2021, which the earnings should come out here at some point. But that's basically my play, is that the growth is going to show up again and the market's going to realize that, like, oh, they're back to growth. So they had a temporary problem. The stock got beaten down unreasonably, I think, and the temporary problem will be removed. History of growing book value very fast. I believe it's over 15% per year history. So if you can get a company that grows at 15% per year, you're going to double your money, or double the value of the business in 5 years. What else? Okay, one more point on them is that if you look at their balance sheet, they have basically their entire market cap in cash on the balance sheet. And some people think this is a negative that they pile up cash, but I love cash. Cash is great. If you have a market cap of $32 billion and you have a cash position of $32 billion, and then everything else offsets itself, all the property debt and the property values offset each other. You're saying basically you're buying this company for the amount of cash that you get in the company, and then you get the business for free. So that's one of the primary things I like, that I think makes it a no-brainer. Maybe they use the cash well in the future. Maybe they don't. Maybe it just sits there. But for me, that's a huge cushion and margin of safety. Third company I'll talk about is Teva, which is a big generic pharmaceutical company in Israel. They also have some proprietary drugs, but primarily they're a generics company. Currently, they're trading at about 3.5 times earnings. They have huge cash flows, over $2 billion a year. I think 2.2 was their projection for 2021. And so, yeah, the whole company is trading at about 4 times free cash flow right now. And so you ask, okay, well, why is it so cheap? That's ridiculously cheap. The issue is they had problems for the last 5 years that have been slowly being dealt with. One was they have a huge amount of debt. The debt has been, they've been basically spending their whole free cash flow paying down the debt. And one of the big catalysts I think I perceive is that they have a goal of getting their debt down to a good level of 3 times leverage. Which is totally manageable, and they have that goal by the end of 2023. They're around 4 times right now, which is actually fine, but they're going to get it down to 3 next year, and that's what the CEO says, and it looks like they're on track to do that. So once they get there, I think the story about the debt in Teva goes away, and possibly the stock re-rates higher, because 4 times free cash flow is crazy. They have two other things that they don't need to happen, but they could happen. They're basically flat in terms of revenue. The CEO, who is actually a rock star, who's just come in to fix this mess, he's now guiding that they'll return to growth very soon. And I think also when that happens, even if they get to a 4 or 5% growth rate, again, the company won't be trading at 4 times free cash flow or 3.5 times earnings. Final issue for them is the legal problems that they've been having. If you know anything about pharmaceuticals in the US, you know that everybody's being sued for everything. And the primary one is the opioid litigation that's ongoing. And I talk a bit about that in the video that I've already done. But basically, this is just a black cloud hanging over them, but they've already expensed a lot of what they think is going to be the cost for this. And worst case scenario, they lose all their cases and end up spending a few $100 million per year as the settlement or as the penalty, which would maybe reduce them to about $2 billion in free cash flow. So even if that goes all badly, it sounds to me like it's fine. It's just people don't like the uncertainty around it. But again, check the video if you're interested in that. I guess the last one I'll talk about today is Australian Family Legal. This is a small cap, let's say micro cap in Australia. It's basically a legal firm that does family law, and which means divorces and separations and stuff like that is their main, their primary source of income. What they are is they're a roll up, which means they're buying other companies and creating a bigger company just by adding other smaller pieces to themselves. They're using their shares and some cash that's cash that's created through their normal business to buy these small competitors. Now that by itself doesn't sound great, it's just whatever. But they've done this extraordinarily well over the last few years, and their goal is to basically grow by about 350% over the next 3 years in terms of their revenue size. So the bet here is that if they come anywhere near that growth level, the stock will go up a lot. I believe that this has 5 or 10 bagger potential, given that it's currently trading at a very low price to cash flow right now. I'm still doing a lot of research into this one, but for me, this is a risk reward play. The stock is quite cheap right now, and the upside's quite high. So it's, as Manish Pabrai says, it's a situation where heads I win, tails I don't lose very much. So that's the quick synopsis on Australian Family Legal. But basically, I would just add that the industry they're in is extremely fragmented. There's no leader. Well, actually, they're the leader, I believe, now. And so what they're doing is they're creating a brand name in the industry, so that the idea is that will create more organic growth when they have that kind of stuff. Because right now it's just tons of little legal firms dealing with this stuff, and there's no brand in the industry except maybe local brands. So they're banking on that30% organic growth. And just quickly looking at the CEO's targets, the targets for the CEO are 30% organic growth rate per year, and that's excluding the acquisitions that they're doing to hit their 350% growth rate in 3 years. They're saying the organic growth should be over 30% for her to hit her bonus levels. So even if the acquisition stuff fails and the organic stuff works, you still have a massively huge growth rate that should drive the stock price up. So there's a few different ways to win here. Either the organic growth works, or the acquisition growth works, or they both work. And in any of those scenarios, I feel like the stock is going to re-rate significantly higher. I think I'm probably going to leave it there today. We're only 20 minutes, so that's quite a bit. But yeah, I'll do another video. I've got another 5 stocks that I'm going to talk about, so I'll do a quick synopsis on those as well, and then I'll do a video on each one individually. Hope you guys got value from this, and yeah, I'll see you in the next video. Thanks.